You want to know what are the best stocks to buy now? I've got 5 high growth stocks plus 2 bonus picks for a total of 7 stocks for you to explore. Let's go. This first stock has been absolute rocket fuel. What's insane about it is how the company has metamorphosized its business model. In just a few years, the subscription revenue from 19% to 73%. And check out this free cash flow growth, almost a 10x in 3 years. And to top it off, the LTM rule of 40 is an 88%. Any guesses on the company? This is beating Palantir's revenue and trading at more than a 75% discount. Don't believe me? Let's take a look.
Wait, you changed your name to McLovin? McLovin?
AppLovin, not McLovin, but AppLovin. This stock has been absolutely hammered by short sellers. The high was over $525 a share, and it got down to around $200 on the April lows. But is this a buying opportunity? Let's zoom in and look at the fundamentals. So back in Q1 of 2023, their ad revenue was $355 million. Last quarter, nearly $1 billion. $1.37 billion in total revenue. That's explosive growth, outpacing retail investor favorites like Palantir. So what's driving this? It's no secret, it's AI. AppLovin's Axon 2.0 uses machine learning to nail targeted advertising, especially for game developers. It correlates players to ad behavior while constantly refining to boost ROI. And it works. The downloads prove it. And now AppLovin's expanding past gaming into e-commerce and potentially even CTV, connected TV, to compete with names like The Trade Desk. With over 10 million businesses advertising online, the potential is massive. They're building self-service tools to scale, and 2025 could see e-commerce revenue soar. AppLovin's AI is not about hype. It's delivering real results. At less than $100 billion market cap, this could easily be a 5 to 10x over coming years. But of course, with high reward potential comes higher risk. Now, before you get too excited, don't get it twisted. These businesses are not the same. And Palantir has been a huge win for our community. Palantir specializes in big data analytics and AI, serving both governments and large corporations, helping them make sense of complex data for critical decisions like national security and business strategy. AppLovin, on the other hand, a very different animal. It focuses on mobile advertising, helping developers monetize their apps and grow their customer base, like those ads that you see in mobile games. Both of these are technically AI stocks, but again, they're very different animals. It's just interesting to see the growth and valuation comparisons. You can see AppLovin 17.3x on that EV/NTM revenue. Palantir's a 74.2x. But the revenue growth, if you look from 2023 to 2024, AppLovin gave you 43.44%, and Palantir just below 29%. And advertising is always cyclical. You can see on your screen AppLovin's business model: advertising 68.5%, apps 31.5%. And looking at the bear and bull case for AppLovin, tremendous growth, profit margins, rule of 40, 88, free cash flow of $2.1 billion for FY 2024. Also announced a share buyback program, diversifying into new markets, CTV, e-commerce. That could be huge total addressable market here. However, this is a highly competitive industry, and you're going against tech giants like Google and Meta. And the stock has been extremely volatile. If you look at the 52-week low, $60.77. That 52-week high over $525. Looking at the EV/NTM revenue of 17.3x, it's the 5th highest when you look at cloud SaaS names, behind Palantir, CrowdStrike, Cloudflare, and Axon. And of course, other risks include regulatory risk, privacy laws, data tracking, and more. You can see that AppLovin has an A+ profitability grade on Seeking Alpha. That gross profit margins, they're high, about 75%. The growth is going to slow down a little bit. Forward revenue growth showing 27.64%. The valuation, we talked about EV/NTM revenue, but it also does have a PE ratio, and it's a 40.98 forward PE ratio. Now, that's expensive, but remember, it's growing into its valuation quickly. For each stock today, I'm going to look at a quick chart. If you see orange text, that's from a previous chart day. We do those every single Wednesday at 9 o'clock a.m. Eastern. If you're interested in joining us in our private community, visit patreon.com/firedupwealth. You can see the stock topped out over $525. It came back to $200.50, trading right now at $279. So this does have a pretty wide range here. The S3 Fibonacci is $137. This R3 is around $355. I was buying this stock in the community portfolio when it was closer to $200 a share. If the market remains bullish, this could be rocket fuel. And if you're a long-term investor and this story plays out like it could, AppLovin could could easily be a bagger stock in your portfolio. The second stock on today's list, let's cover a cybersecurity SaaS company. This company is called Rubrik. Data backup and recovery, ransomware recovery, data migration, data analytics and reporting, and simplified management. So Rubrik safeguards data, and this can be used for VMs, databases, on-prem, as well as cloud, and even unstructured data. So it's going to help monitor risks like ransomware. It also tests and orchestrates recovery workloads. This is a cloud-native platform with a zero trust design. It provides holistic cyber resilience. And this is an excellent slide, a very good visual. So you've got your cyber integrations over here. Palo Alto Networks, Zscaler, CrowdStrike, Mandiant, and more. And over on this side, you have the enterprise on-premises. So this is gonna be everything from cloud, SaaS, unstructured data, identity management. So you've got automation and APIs. This helps connect data to other applications. And this is gonna give you comprehensive data protection, data threat analytics, data security posture, and cyber recovery. So it's not competing against the companies like Palo Alto, Zscaler, and CrowdStrike that we love. It's complementing them. We believe that generative AI is a significant catalyst for our growth because AI adoption requires data security, and AI drives new products for evolving threat landscape. So think of Rubrik as resilience, and Palo Alto, Zscaler, CrowdStrike, prevention. Some strong numbers here. So subscription ARR, that's annual recurring revenue, 39% year-over-year growth. 2,246 customers with over $100,000 in ARR. Those gross margins are strong. Of course, SaaS software, 78%. And cloud is growing at 67% year-over-year with a dollar-based NRR, net retention, over 120%. Rapid subscription growth. This is a great slide as well. This is exactly what you want to see as an investor, and this is 39% year-over-year growth. This is a fairly new IPO, not profitable. You can see some improvements here though. From negative 20%, which of course you don't want to see, to positive 2%, so trending in the right direction. So profitability, I mentioned this is a new IPO. This company's still growing. It's not profitable. You got a C- ranking here on Seeking Alpha. Now it's showing a TTM 12 months trailing gross profit margin of 70%. Those numbers are improving. You saw on a previous slide. The growth is strong on A, revenue growth 41% year over year, forward revenue growth 32%. Again, not profitable. So we have to look at those SaaS cloud metrics. Forward price of sales is 11.57. EV NTM revenue, 11.5x. NTM rule of 40, 49%. Really strong. We don't have a lot of data on the chart because this was a new IPO just last April. You can see it topped out at exactly $80. Dropped to $47.35 on the recent low. And it's already back up to $71.67 today. This is showing bullish momentum though, and it could go higher. This R3 is up here at $87.34. Now I get it. It would have been a lot better to buy it under $50 a share. I totally agree. You're not going to have earnings until middle of June. If I'm buying Rubrik, I'm probably buying a quarter position and I'm waiting for those earnings. But for long-term investors, I do believe that this stock is one you should have on your radar. And if there's a significant sell-off, it would be an opportunity to add shares. Number 3, a small cap with massive potential and a pure play for AI data center. Astera Labs is all about data center connectivity, and it's positioned as a key player in the AI infrastructure boom. In fact, its chips were in over 80% of AI servers as of last spring. The company targets hyperscalers, is working closely with companies like Amazon. Astera Labs has shown explosive growth driven by surging AI accelerator demand. Now here's the question. Can this small company, even though it has first mover advantages, can it sustain its dominance against the larger players like Broadcom and Marvell Technologies? Astera's vision is to build a global connectivity platform. And even though these products in connectivity have huge margins, it's a very competitive market and customer concentration risks do remain. With that said, it's our second largest holding in the community portfolio. So $10.77 billion market cap, a forward PE ratio of a 51.8. But look at this, 242% revenue growth. So it's growing into this valuation very quickly. This article from Raymond James, outperformed price target $82. As a leading supplier of high-speed connectivity solutions, A-Lab is well positioned to benefit from the Gen AI megatrend. In addition, the recently announced Scorpio Fabric switches nearly double the company's serviceable addressable market, or SAM. And this article calls Astera Labs the Switzerland of AI, defying status quo. Now, with that said, the price at publication, $127.70, it's down 45% since. So is this a massive opportunity to buy the stock right now? So not that you'd ever buy off a price target alone, but 13 buy ratings and 1 hold. $109 is the average price target. That's a 58% upside. The highest price target is 140. The lowest is 70. Considering that it's hardware, the gross profit margins are really good. In fact, higher than NVIDIA. 76.38%. Profitability grade right now is a B on Seeking Alpha. The growth is out of this universe, 242%. But you're going to pay a premium for that growth. The forward gap PE ratio, 224.66. Forward price to sales, 15.95. Another small cap you can look at in this space. This is CRDO. Market cap, 7.31 billion. Forward price to sales, 17.14. This was also a new IPO in 2024. You can see it topped out at $147 a share. Dropped all the way to $47 a share, so a $100 drop. Right now it's trading around $69 a share. Fibonacci S3, $39.64. And the R3 is closer to $80 a share. So I'm not expecting Astera Labs to go back to $150 anytime soon, but I still like the stock right here at $69 a share DCA. But keep in mind that earnings are right around the corner on May 6th. So this stock could pop or drop. If you're buying shares, leave some room. Number 4 is a stock that we've covered a lot in Discord. I've done some due diligence as well as the man. Coherent, ticker is COHR. They develop, manufacture, and market engineered materials, optoelectronic components, and optical laser systems. So they have 3 main areas: networking, materials, and lasers. So the Photon is Coherent's foundation, and the CEO worked previously with Electron Technology. Coherent does 3 applications of the Photon: AI data centers, lasers, and bouncing photons to measure or sense things. I believe that photon technology has tremendous potential over the next decade. Photon and light replaces rare earth metals like copper, and the company is seeing tremendous demand. The data center revenue grew 80% year over year last quarter. The best way to add bandwidth is optical networking, and the company has 3,100 patents. So this is a good visual. $4.7 billion of revenue in FY 2024, well diversified across technology, products, and geographic markets. So you can see lasers 29%, networking 49%. This is where the growth is at, and materials 22%. But markets covered include communications about half, industrial 36%, electronics 8%, and also instrumentation. So think high-powered microscopes and more. About 56% is North America. It does have 15% exposure to Europe, 13% China, 13% Korea and Japan. This gives you an idea of the TAM. So $22 billion for industrial, $23 billion, and so on. The CAGR, the compound annual growth rate, 20% electronics, 14% communications. You can see revenue up 28%, gross margins, nice improvement there, earnings per share up 357%. The gross profit margins and profitability are going to be a little bit lower, so 33% in the gross profit margin, a C+ rating on Seeking Alpha. Valuation-wise, the PE gap forward is a 64, so it's not a cheap stock, but you can see it's growing into that valuation nicely. Current market cap is $9.97 billion, so this is under a $10 billion market cap. Remember, guys, this video is about high risk reward stocks, the kind of stocks that we buy in the community portfolio, the kind of stocks I buy if I'm 20 years younger, trying to grow aggressively in the accumulation phase of wealth. You can see the stock is up 7.54% today. There is a lot of excitement about this company in the future. So about 2 years ago, in May of 2023, this stock was $26. It ripped to $113.60 a share and fell off a cliff like most stocks, especially if they're tied to AI. Big air pocket here, down to $45 a share. We've been buying this in Discord and in the community portfolio in these levels here. Right now, the stock is about $69 post-market. This is another one with earnings just around the corner, May 7th. I like this stock under $70. I prefer it lower. If you're gonna buy some here, save some room, and maybe even just wait for earnings. And this is gonna be tied to the AI trade. So if those AI stocks sell off, this is gonna sell off along with them. Next, I'll cover stock pick number 5, and right after that, a quick bonus pick. Please remember to subscribe, like, and comment. Samsara. This is a software as a service SaaS company. Think Internet of Things. It's all about IoT and fleet management. Their mission is to enhance safety, efficiency, and sustainability for physical operations globally. Its platform leverages IoT data for actionable insights across industries like transportation, construction, and logistics. It serves tens of thousands of customers in North America and Europe, including public sector clients like the city of Boston. Their AI-powered solutions feature AI dash cams, real-time GPS, telematics, fleet safety, and compliance. It provides routing and dispatch and driver apps to optimize operations and reduce costs, as well as accidents. Their asset tracking monitors high-value items with devices like tags, improving inventory management. Samsara also helps with sustainability, helping to reduce fuel usage and carbon footprint. And they do this through data-driven insights. So the gross profit margins are going to be high because, again, this is software as a service, 76.2%. The growth is solid, an A. 33% with forward revenue growth of 26%. Valuation wise, this is a SaaS company, so we have to look at that EV/NTM revenue. And for IoT, you're looking at a 14.2x. That's going to be the 7th most expensive SaaS stock. $22 billion market cap. Short interest is 4.5%, something to be aware of. The quant on Seeking Alpha is showing a strong buy. It's not necessarily a reason to buy, but just to point out. And both Wall Street and Seeking Alpha analysts are rating it as a buy. This company is also reporting earnings in May. It's later in May. But the stock ripped from $8 back in December of 2022. It's $8.86. It ripped all the way up to $61.90. Huge air pocket. That air pocket has been popped. Most recently here, the low $31.40. Right now it's trading at about $40 a share. My preference for this stock is $30 or less DCA, which may or may not happen. The Fibonacci S3 is 28.17. It becomes a strong buying opportunity below $30 a share. But this is a high growth company and it fits the list well. And like with all the stocks we talk about today, use dollar cost averaging DCA. All right, a quick bonus pick. I actually bought more shares of this stock today. The question you have, hey, Eric, why is Confluent stock down today? It beat on the top and bottom line, so what is going on? The answer, full year revenue guidance missed significantly, and its revenue guidance for next quarter fell short of Wall Street estimates. It also has high SBC, and it's not profitable, so it's not fashionable in this type of market. With that said, full year EPS guidance exceeded Wall Street estimates, and the EPS guide for next quarter blew past expectations. The sell-off in early May, the stock got down to $18.27. Right now in post-market, it's $19.32. There's a decent chance we retest that $18.27, and the S3 is $15.96. I like this stock under $20 DCA. Below 17 is where the opportunity gets very strong. Don't forget to subscribe, like, and comment. Thanks for watching. Have a great rest of your day. Take care.